Hello everybody, this is Books of the Stock Market. How's everyone doing? As for me, I just came back from my run and it was fairly warm, unlike earlier this week where it was mostly 45 degrees Fahrenheit. I also bought a new mic. The mic that I was previously using was like a cheap headset mic and it would be too close to my mouth, so I had to edit out a lot of audio popping sounds. But you guys probably could hear some of it, and I thought that getting a new mic would solve this issue. Anyways, now that I have a proper mic, I'm hoping that the audio quality is much better. Now getting on to today's topic and why you guys are all here. So last week we talked about a theory that founded technical analysis, which was the Dow theory. As for today's video, we'll be still in the realms of very basic stuff, and it's made for people who are entirely new to technical analysis and reading charts. So if you're familiar with the basics, you could skip this video. However, it will not hurt to watch this video, as getting refreshed on the basics is never a bad thing. Also, I'll be presenting a lot of examples throughout the video, so watch till the end of the video, as applying and just knowing are entirely different things. Okay, the topic we'll be going over is how to accurately read charts, whether they be charts of the stock market or futures. First, let's start off with the different types of charts that are used in today's financial markets. In this video, we will examine 4 charts and explain how to read them and when to use them. The first chart we'll be looking at is called the daily bar chart, and this shows each day's range. As for the second chart, we'll be looking at the candlesticks chart, and this is basically the Japanese version of the daily bar chart. The third chart we'll be looking at is called the line chart, and the line chart is what most people will be familiar with, as it is just a line graph that shows the closing prices. The final chart we'll be looking at is more rare because of its specialized use case, but it is still used, and it is called a point and figure chart. And this type of chart usually helps traders see buy and sell signals more quickly. Okay, let's start off by diving deeper into the first chart, bar charts. So what are bar charts? Basically, bar charts are used to show each time period's trading range. The time period's trading range is represented by a vertical line, and the time period or the vertical line that represents it can be defined as anything, whether it be 15 minutes or even a whole year. A shorter time period, such as a day, will be used to figure out short-term trends, while a longer time period, such as a year, will be used to figure out long-term trends. Each line shows the opening price, the high, the low, and the closing prices. So what does this mean? Well, let's look at 2 pictures. This is a bar chart. In this case, the vertical line represents the time period. The endpoints of the vertical line represent the high and the low of the price action that happened during the specified time period. The tick to the left of the vertical line represents the opening price of the time period, and the tick to the right of the vertical line represents the closing price of the time period. In this case, since the open is lower than close, this means that the price action was moving upwards. The opposite can be said for a more bearish price, where the open will be higher than the close as shown. Let's now look at a real-world example. The stock we'll be looking at is the United Health Group, and I defined the time period of each bar as 5 minutes as shown in the circle. This means that each bar you will see will represent a 5-minute time frame, so after every 5 minutes, a new bar will be created. When the new bar is created, the price of the bar is known as the opening price. So if we are using the last bar of the day on October 9th as our focus, we see that the opening price was at around $327.12. From there, we'll see prices go up and down during the 5-minute time period. The point at which the price is the highest is called the high of the bar, and in this case it was $327.94. The point at which the price is lowest is the low of the bar, and in this case it was $327.03. At the end of the 5-minute time frame, the price was $327.71, and this is represented by the close of the bar, or the right tick of the bar, and then this process starts all over again. The next type of chart is very similar to the bar chart. Basically, this is the bar chart of Japan, and it is really the most popular type of chart that's used today. Like the bar chart, candlesticks show the open, the close, the high, and the low. Since candlesticks represent the same type of information as the bar chart, candlesticks are also used to understand each time period's trading range. Okay, let's look at an example. The body of the candlestick represents the time period, with the ends of the body representing the opening and closing prices. The wicks that are attached above and below the body of the candlesticks represent the highs and the lows. The only difference between bar charts and candlesticks is how it represents bullish and bearish price action. Unlike bar charts, candlesticks represent bullish and bearish price action through colors. A bullish price action would show a candlestick with a shade of green, while a bearish candlestick would be any shade of red. In the case of a green candlestick, the opening price will be at the bottom of the body, while the closing price will be at the top of the body. In the case of a red candlestick, the opening price will be at the top of the body, while the closing price will be at the bottom of the body. Let's look at a real-world example so we can solidify what we just learned. The stock we're looking at this time is Best Buy. We see that each candlestick represents a day as shown in the circle. Now, let's focus on the last or the most recent candlestick. This candlestick represents the price action of October 9th. We see that on October 9th, the price of Best Buy opened up at around $115.33. From there, we can decipher the price action that happened during the day. So we see that the low of the day, which is represented by the lower wick, was $115.07. On the other hand, the high of the day, which is represented by the upper wick, was around $118.24. The closing price of the stock on October 9th was $116.59. As you can see, bar charts and candlesticks basically represent the same type of information, and they can be helpful in understanding price action. Later videos will go in deeper on what you can learn from these types of graphs. For instance, what does it mean if like the lower wick is extremely long, or the upper wick may not even be existent. However, for this video, this is enough to give you guys a solid basis on how to read bar charts and candlesticks. Now, let's move on to the next type of graph, the line chart. The line chart is what most people are familiar with, and although they do not give as much information as bar charts or candlesticks, line charts are good at representing the closing price, as that's like the only thing it represents. The focus on closing price is not bad. In fact, many technical analysts argue that the closing price is like the most important factor when defining trends, as anything else may just be noise. So let's look at an example. The stock I have is called Carnival Cruise. Since the line chart only describes the closing price, finding the closing price for each day is very straightforward. So let's look at the closing price for October 9th, and it was $15.69. On October 7th, the closing price was $16. Fairly simple, right? Okay, let's move on to the last chart. The final chart we'll be looking at is called a point and figure chart. So honestly, I do not use this chart, but while reading through the material, this chart came up. And this chart is very straightforward and is used as like a chart to see buy and sell signals. So how does it do this? It does this by having X's represent rising prices while O's represent declining prices. Now let's analyze this example. So this is Boeing, and the stock has been extremely volatile in the first week of October due to whispers and rumors of new stimulus for airlines. Using this chart may have helped traders navigate through volatile times. For instance, if there are a bunch of X's that start showing up, it usually means that it is time to buy, as shown in the purple box. On the other hand, if a bunch of O's start showing up, you better sell, as shown in the cyan colored box. Like I said, personally I do not use this chart for buy and sell signals, but I thought I might as well include it because this video is not for me but for you guys, and some people may find it useful. Also, more knowledge can never hurt. Now that we're done with analyzing popular charts, we can move on to the log and arithmetic scale that affects all charts. The arithmetic scale puts the ticks on the y-axis such that they're all the same distance from one another. On the other hand, the log scale puts the ticks on the y-axis such that the doubling distances are at equal lengths. So what does this mean? Well, let's look at an example. On an arithmetic scale, the distance from 10 to 20 will be the same as the distance from 50 to 60. Although this may make sense, as 20 minus 10 and 60 minus 50 is both 10, the percentage difference between these two numbers are drastically different. An increase from 10 to 20 is a 100% increase, while an increase between 50 to 60 is only a 20% increase. Should these two distances really be the same? Well, the log scale takes into account these differences while the arithmetic scale doesn't. With that mini math lesson out of the way, let's look into why technical analysts use the log scale so much. So technical analysts use the log scale so much because sometimes the trend lines just fit better. So let's look at this graph. This graph represents JP Morgan, and this stock is a stock on my watch list because it has been consolidating a lot and I'm betting on it moving to the upside. Anyways, we see that the purple trend line has 3 touches on the log scale. What would happen if we got rid of the log scale and switched it to the arithmetic scale? We see that the purple trend line not only has 2 touches, and 2 touches are at the very ends of the trend line, which makes this trend line not very good, as we will learn in later videos. Although I couldn't find any real-world examples where the log scale would have numerous touches while the arithmetic scale will only produce few touches, this does happen. For instance, there are times when the log scale would have 5 touches, but the arithmetic scale will only have like 3 touches. This is the reason why you see many traders use the log scale because it just allows the trend lines to fit better. That's it for this video. I hope everyone learned as much as I did reading the book, as that is the whole point of this channel. So far, we are introduced to the basics of charting, which is necessary to understand before we do any technical analysis. When looking ahead to the next couple of chapters, we will be learning how to draw trend lines. So if you don't want to miss out on these topics, please subscribe to the channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports the channel. If you have any questions, leave a comment below and I'll try my best to answer all the questions. Well, this is Books of the Stock Market, and I'll see you guys next week at 3 p.m. Central Time. Thanks.